Welcome back to the exchange. Oil jumping nearly 6% today as the Trump administration puts additional sanctions on Russia's two largest oil companies. WTI crude now at $61 a barrel, Brent at 65. Our next guest says the physical impact will be immediate. For more, let's bring in Jeff Currie. He's Chief Market Strategy Officer of Energy Pathways at the Carlyle Group. So Jeff, sort of get us up to speed here. We were talking about this oil glut in the market, and now we're talking about sanctions on Russian oil. So does the move in oil feel appropriate for how much the market may lose when it comes to Russian oil and thus propping up the prices as supply falls?
Well, this just shows the dangers of how big that short position that was developed in this market around the epic supply glut that was coming. I'm not dismissing the supply glut, and given the news today, that too start to make a little bit more sense. But I think at this point right now, it's still too early to assess it. And why do I say that? Is that the U.S. did not apply secondary sanctions. And that's really important because secondary sanctions would be anybody who transacted with U.S. oil be taken out of the U.S. SWIFT system, and they'd be forced to be in the Chinese CIPS system. What we're going to find out in the coming days is how big that loss is. So everything were to be lost 5 million barrels per day. This is a world-class supply disruption. The reality we'll find out is maybe it's 1 million or something of that nature. We do know barrels of oil have already been, loaded in Guyana and heading to India. So there are groups that are unwilling to take that risk, but we won't know the full extent of it for a while. So, I would tend to think, you don't want to be this short oil in these types of events.
So if you don't want to be this short oil, I mean, where do you think then the price could go? We're sitting about $62 a barrel right now for WTI.
Well, when you're looking at the upside here, you've already rallied somewhere around $5 off the lows. You could rally another $5 plus on this. I think getting over 80 would be really difficult. You'd really have to have a substantial shock to the system to be able to achieve that. But in terms of thinking about the very immediate situation, we're seeing the unwinds of these shorts. The people had the shorts, they were short the curve, and so you really saw it flip. But I think what's going to happen in the next couple of days, we're going to get information which refineries are going to be unwilling to take the Russian oil. We'll have a better assessment of this, and then that's where we'll probably move to the higher levels. Another $5, $10 a barrel wouldn't be completely unreasonable, again, given how short the market is. But the pushback we're going to get from a bullish perspective is, what about that big oil glut, the flotilla of oil at sea?
Right, exactly. I mean, obviously, there's so much of the moves in oil prices that are geopolitical in nature, obviously economic implications around the world when it comes to the supply glut as well. When you're putting this all together and we're talking about sanctions, how effective are they? I mean, does it really do what we think it will do? Do companies or countries rather really comply with what they're supposed to do?
The answer is that no, they're not effective. Clearly, they aren't right now. They would be effective if you're willing to employ secondary sanctions. But the time I've seen secondary sanctions applied against Rosneft in March of 2018, it's a shock to the system because nobody's going to touch it. It becomes a hot potato because you don't want sanctions yourself. And that's why the U.S. government is so reluctant to do it. But that would stop everything. But what's different between then and today, and this has been driving a lot of gold. Gold is the de-dollarization trade is starting after they saw those secondary sanctions in 2018. The Russians reduced their debt exposure, started buying gold, greenbacks to actually transact in. Then the Chinese did it after the central bank freeze. So a lot of that demand you're seeing in gold is to get around these sanctions. But I think the key point is, it is very disruptive. If you go the secondary sanction route, it would be effective, but it would be extremely disruptive. And I think the question is, what refineries are willing to take that risk? Because they say after November 21st, they will then, that's a threat. They'll use them after the 21st, but they did not use them at this point.
Well, you've given us a lot to think about here. And of course, we just showed the chart of gold up about, 57% or so year to date, and very interesting points about the interconnectedness there. Jeff Currie, thank you for joining us here.